In this trading framework, a transaction set is a closed-loop sequence of options trades designed to generate a predictable stream of income. This specific case study focuses on a sequence that produced a double-digit yield in less than 2 weeks. Looking at the ledger, the days in transaction set confirms the process completed in exactly 13 days, producing an average daily premium of $45.23. Against required capital, the total yield reached 11.438%. This double-digit return is the result of managing the specific spread between premiums collected and the costs associated with replacing or maintaining the underlying stock. Standard accounting metrics can be misleading here, as they often fail to track the immediate liquidity generated by selling options. To counter this, the trader uses a custom free cash flow model. The formula for this strategy is straightforward. Free cash flow equals the premiums received, plus or minus the net replacement cost of the shares. The most efficient outcome for the seller occurs when a contract reaches its expiration date without being exercised by the buyer. Under these conditions, the replacement cost remains zero. This allows the trader to retain the full premium, resulting in a 100% yield for that specific contract. To see this in practice, we have to look at the trader's work with American Eagle Outfitters, ticker AEO. The goal is to maximize free cash flow by either keeping the entire premium when contracts expire worthless, or by systematically pivoting when the market triggers a replacement cost. The transaction set begins on August 3rd with a baseline trade intended to harvest immediate premium. The trader opened the sequence by selling 7 put contracts with a strike price of $17. Selling these contracts generated an initial cash influx of $154. This row is color-coded green because the market price of AEO remained at $17.96. Since the stock stayed above the $17 strike price, the contracts expired without being exercised. Following the free cash flow rule, the trader banked the full $154 as profit and immediately freed up their collateral for the next trade. This first phase represents the pure income portion of the cycle, where market pricing allows the trader to retain the entire premium. The second trade in the set reflects a shift in the trader's outlook as they prepare for a change in market direction. Anticipating a downturn, the trader noted, "I believe the market is way overdue for a price correction, so I'm being conservative in setting strike prices." Despite this conservative stance, they sold 7 more puts for the August 14th expiry, moving the strike price up to $17.50. The correction arrived quickly. AEO's price dropped to $16.31, falling significantly below the $17.50 strike. Because the stock was now in the money, the buyer exercised their right to sell the shares. On Thursday, the trader was forced to buy 700 shares at the $17.50 strike. This triggered the replacement cost mechanism. The trader now holds 700 shares with a cost basis higher than the current market price. Within this system, being assigned stock marks a phase shift, moving the portfolio from selling insurance contracts to managing a physical inventory of shares. Having acquired the stock on Thursday, the trader executed an immediate countermove on Friday morning. They pivoted to a covered call strategy, selling the rights to the 700 shares they just purchased to collect a third round of premiums. This pivot generated $259, the highest single premium collection in the entire 13-day set. By setting a $16.50 strike price, the trader created a high probability chance of either generating more income or offloading the stock if the price saw a minor rebound. By Friday, the trader had utilized the market correction to create the largest cash flow event of the period. Success in this strategy is not measured by the profit of a single trade, but by the long-term growth of the entire portfolio. Traders using this model focus on a metric called contract capacity, which tracks the total number of options contracts they are able to cover at once. The trader defines their success explicitly as maintaining or increasing the number of contracts I am able to cover. This means premium income is treated as fuel for the next set rather than spendable cash. At the end of this AEO sequence, the trader used their accumulated premiums to increase their operational capacity from 6 contracts to 7. In this model, success means selling a higher volume of contracts today than they could yesterday, regardless of overall market volatility. This focus on capacity leads to a counterintuitive conclusion. Lower stock prices can actually be a benefit for a premium seller. As the trader points out, a declining stock price often makes it easier to increase the number of contracts they can cover. When share prices drop, the collateral required to secure a contract also decreases. This allows the trader to use their existing capital to scale from 7 contracts to 8 or more. The anatomy of a transaction set is therefore a resilient loop, one that uses cash flow and contract replacement to drive continuous expansion. Ultimately, the effectiveness of the strategy depends on maintaining the internal logic of the transaction set, even as external market conditions fluctuate.